The market is crashing, investors are losing millions, and economic uncertainty is at an all-time high. But imagine this, even during a crash, you're still getting paid in dividends. There are several dividend-paying ETFs that continued paying throughout the 2020 COVID crash and the 2022 rate pullback, and today they're still going strong. In this video, we'll break down 3 of those ETFs, including their top holdings, sector exposure, payout history, and most importantly, how they performed during tough times in the market. By the end of the video, you'll understand exactly why investors are chasing these resilient dividend ETFs. The first ETF we're going to look at here today is Vanguard's High Dividend Yield ETF, ticker symbol VYM. It has a low management expense ratio of just 0.06%, and most importantly, it has a dividend yield around 3% paid out on a quarterly basis. VYM tracks the FTSE High Dividend Yield Index, which holds over 529 companies, giving it a broad exposure across sectors. Now, what are the holdings that actually make up this fund? When we take a look at that, we'll find some dividend giants like Broadcom, JP Morgan, ExxonMobil, Walmart, and Procter & Gamble. These are all well-established companies known for their steady payouts. Now, looking at their sector allocation, the largest sector is financials, around 22%, and after that, it's well diversified with about 10% each in consumer discretionary, consumer staples, energy, healthcare, industrials, and technology. Now, this ETF is pretty diversified, but the best part is how it holds up during downturns, both in terms of price and dividend stability. When we look at the dividends, VYM has delivered 18 consecutive years of dividend payments with 14 years of consecutive growth. Over the last 3 years, its dividend growth rate is nearly 6%, while the 5-year average sits at 1.5%. Now let's look at VYM's share price and how that performed during market turbulence. Let's compare it to the S&P 500 over a 5-year period, from 2020 to early 2025. During the 2020 crash, VYM moved closely in line with the S&P, but in the 2022 market pullback, it held up a bit better. At the start of 2022, VYM was trading around $114, and by the low that year, it dropped to about $95. This is about a decline of 17%. Meanwhile, the S&P 500 took a steeper loss of about 22.5%. Now, no ETF is immune to volatility, but VYM's consistent dividend growth and stronger stability during downturns make it a go-to option for income-focused investors. Now let's move on to our number 2 ETF, another solid fund that continues to deliver. This is Vanguard's Dividend Appreciation ETF, ticker symbol VIG. It comes with a low management expense ratio of just 0.05% and a dividend yield just under 2%, which is paid on a quarterly basis. VIG tracks the S&P U.S. Dividend Growers Index, which only includes companies that have increased their dividends for at least 10 consecutive years, a strong filter for both quality and consistency. But what companies is this fund actually holding? There are over 300 individual companies within this ETF, and its top positions include Apple, Broadcom, JP Morgan, Microsoft, and Visa, all well-established, reliable dividend payers. When we look at their sector breakdown, it's about 24% technology, 22% financials, and 14% healthcare. So compared to VYM, VIG has fewer holdings and a heavier tilt towards tech and growth-oriented dividend stocks. Now let's take a look at its dividend performance. VIG has delivered 18 consecutive years of dividend payments with 11 straight years of dividend growth. Its growth rates are strong, about 7% over 3 years and 11% over 5 years. That's some solid compounding. But just like VYM, we should also look at how VIG held up during those market downturns. So we'll look at that same 5-year period from 2020 to early 2025, and VIG tracked fairly closely to the S&P 500, but during the 2022 crash, VIG opened at around $170 per share and dropped to about $135 per share, roughly a 20% loss on the share price. Comparing this to the S&P 500, which also lost around 22.5% in that same time, VIG held up slightly better, but still experienced some of that downside. Now let's jump over to our number 1 ETF. This one might surprise you. Taking the number 1 spot on this list is one of the most talked about dividend ETFs out there, and that is the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. This fund has gained a loyal following, and for good reason. It offers strong dividend yield, historically between 3.5 to 4%, with a very low management expense ratio of just 0.06%. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which screens quality companies with at least 10 years of consecutive dividend payments, strong fundamentals, and a history of dividend growth. SCHD also holds around 100 companies, making it more concentrated than VYM or VIG, but that also means each holding carries more weight and focuses on high-quality businesses. Some of its top holdings include ConocoPhillips, Chevron, Verizon, Coca-Cola, and Bristol-Myers, strong names across several sectors. Its sector breakdown is led by energy, consumer staples, and healthcare, each with a solid percentage of the portfolio. Now let's talk about dividends, because that's where SCHD really shines. They have had 13 years of consecutive dividend growth, and its dividend growth rates are very impressive, with both a 3 and 5 year average increase of 11%. And during market downturns, SCHD has been quite resilient. We'll look at that same 5-year period that we've been looking at for other ETFs, and in 2022, it opened around $27.22 per share and bottomed around $22, a decline roughly of 18%, similar to VYM and notably better than the broader market in the S&P 500. Now, despite that drop, SCHD continued to raise its dividend even during this pullback, and that's what makes this fund so appealing. Strong dividend growth, reliable payouts, and solid price performance, all wrapped in a low-cost ETF. If you're looking for long-term passive income with growth potential, SCHD is pretty hard to beat. Now on the screen, what we're looking at is a $10,000 comparison between these three ETFs and their performance over the last few years. Now, I also want to point out, big takeaway with all of these ETFs is that time in the market matters more than timing the market. All of these ETFs have had solid long-term returns, even with their different strategies. SCHD leaned into a dividend growth with strong capital appreciation, VIG stayed consistent with reliable companies that raise their dividends year after year, and VYM paid a higher yield along the way, appealing to more income-focused investors. What's interesting is that each fund has a slightly different purpose. SCHD gives you a bit more growth, VIG gives you a bit more reliability, and VYM gives you a little bit more cash flow. Depending on your investing style, age, and goals, you might prefer one over the others, or use all three together in a well-diversified dividend portfolio. And that's the real power of ETFs like these. You're not trying to beat the market week by week, you're building income and growth over time. So if you stayed invested, stayed consistent, and reinvested your dividends along the way, you'd make miles more than other investors trying to time every single move. Let me know in the comments below which ETF you would personally pick. Do you prefer a higher yield, long-term growth, or a mix of both? Or maybe you like an ETF that wasn't included on this list. If you found this breakdown helpful, give it a thumbs up and consider subscribing for more long-term investing content.